one kind of message that I want to, make sure that people leave with today is the fact that we have continually, and we still are underestimating the power of that fiscal. And everyone's saying, well, all the money's been mailed out, all the savings are finished, but there's still a lot of money in terms of the Inflation Reduction Act, which is basically an infrastructure act that still hasn't been spent. If you think about the government, if there's one thing we know is that they're slow. So when they allocate money to go out and spend, to build chip fabs or whatever it is in Texas, that doesn't get done right away. And when you go look at the state level, you'll see that sort of infrastructure spend is just starting to hit now. And that's why I think that people that have continually believed that this monetary kind of tightening would stop the economy have been mistaken in that they've kind of continually underestimated the power of fiscal.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. We're all aware of how the pandemic threw the economy and financial markets into unprecedented disarray. And for the past 2 years, investors have eagerly awaited them to return back to a state of normalcy. But has normal changed versus the pre-COVID days? How much of the old playbook no longer works well, if at all, in today's world? For answers, we're fortunate to speak today with market veteran Kevin Muir, founder and editor of The Macro Tourist, the highly acclaimed newsletter that currently ranks as the number 12th largest financial Substack in the world. Kevin, thanks so much for joining us today.
Well, thanks for having me on. It's a real pleasure.
Hey, it is a real pleasure, Kevin. Been a huge fan of your work for many, many years. It's wonderful to finally meet you in person. Thank you for making the time here in the holiday season to come on the channel. Lots to talk about with you. If we can we just jump off at the high-level question I like to start these discussions with? What's your current assessment of the global economy and financial markets?
Well, I think you framed it really well, Adam, when you talked about how COVID has changed the world. And I kind of continually am amazed at how everyone's expecting this cycle to look like all the other cycles. And I have a buddy, Dario Perkins from TS Lombard, and he's been saying for a while, he says, I don't know why we're expecting this business cycle to look like other business cycles. Because if you think about it, we sent everybody home, told them that, where this pandemic is hit, everyone go home. Then we mailed everyone checks. Then we went and reopened half the economy, then the other half. Then we did another, Inflation Stimulus Act or Inflation Reduction Act, but it's in essence an infrastructure bill. This cycle is so much different than all the previous other cycles. And I think that a lot of the playbooks that we used to use in terms of like yield curve or this, the soft indicators versus the hard indicators, all those things kind of need to be rethought. And that's what I think a lot of the investors are struggling with. And I think that's what we should chat about today.
Okay, great. I really want to dig into that. We've talked a lot about the unprecedented deformations that COVID wreaked on the economy and on the markets. So we've talked about that a lot on this channel. Would love to get your thoughts, your specific thoughts on that as we get into this in terms of what specifically has changed that we have to pay the most attention to and what you think it's likely to bring in the future. I know some of this it's a little bit of a crapshoot because you're in some ways trying to predict what something that's never been in the state before is going to do. So it's going to keep things interesting. But look, it's been quite a year in 2023, right? We went into this year, kind of like you said, everybody kind of looking at old playbooks saying, oh, okay, well, look, obviously a recession is going to happen, early this year. And 2023 was really the year of the recession that wasn't. And here we are at the end of the year. And, everybody's kind of on the no landing plane at this point in time. Markets are I want to say they're in melt up. If they're not in melt up, they're on their way to melt up status.
Yeah.
Nobody seems real worried at this point about a recession. Powell certainly isn't, right? He basically just gave everybody the green light that, hey, not saying mission accomplished just yet, but I can see the light at the end of the tunnel here. Yeah. Obviously things outperformed everybody's expectations. Why? What do you think is responsible for this huge surprise to the upside?
Fiscal. And I think that people have missed this the whole way along. They've underestimated the power of fiscal. And if we think back to 2008, when we had the great financial crisis, we tried to fix everything with monetary stimulus. We lowered rates to zero, and then that didn't work. We did QE. And then when that didn't work, we tried Operation Twist. And then we tried Operation QE number 2 and number 3. And that was one of the slowest recoveries on record. Then fast forward to 2020. Well, this time we learn our lesson and we say, well, monetary stimulus doesn't work as well as we think it does. Let's try some fiscal. And not only did we try fiscal, we did way, way too much. And it's just it's crazy how much we've done. Especially like I'm a Canadian, but America, when you look at the amount of fiscal as a percentage of GDP versus the rest of the world, they did way more. You guys did absolutely, I think it's 24% of GDP in terms of fiscal stimulus. The next closest was 18. I think we were 16% of GDP. So we not only did we have the kind of the monetary stimulus that everyone has always been afraid of and talking about, but we've had this unprecedented shift in terms of the amount of money that the government has spent and has put into people's pockets. And the one kind of message that I want to, make sure that people leave with today is the fact that we have continually, and we still are, underestimating the power of that fiscal. And everyone's saying, well, all the money's been mailed out, all the savings are finished, but there's still a lot of money in terms of the Inflation Reduction Act, which is basically an infrastructure act that still hasn't been spent. If you think about the government, if there's one thing we know, it's that they're slow. So when they allocate money to go out and spend, to build chip fabs or whatever it is in Texas, that doesn't get done right away. And when you go look at the state level, you'll see that sort of infrastructure spend is just starting to hit now. And that's why I think that people that have continually believed that this monetary kind of tightening would stop the economy have been mistaken in that they've kind of continually underestimated the power of fiscal.
Okay. And we've talked about this on this channel before, where it's funny. I'm going to go through a quick evolution of ways in which I've talked about this as I've talked to different guests, but I used to position it as the Fed was putting its foot on the monetary brakes on the economy. And yet on the fiscal side, we were jamming the accelerator. And actually the Fed and the banks, that were putting on the brakes, and the fiscal side jamming the accelerator. And it seems to date that the accelerator has been winning out, right?
That's correct. Yep.
Yep. And first, let me ask you a question that I've asked a lot of people in the past. Haven't asked it for a while, so I'm curious to hear your thoughts. If you consider all the excessive stimulus that we shoved into the system during COVID as the proverbial pig within the python,
okay,
what's your best finger to the wind guess of how much pig is still left in the python? And maybe in your answer too, there are still some programs out there that seem like they're even still like feeding the python pork chops. Like he's not on a starvation diet yet. So how much has left to pass through that? Are we past halfway? Are we on the dregs, or is this bigger than folks are expecting still?
So I think that you need to think about the stimulus in different ways. And there's no doubt that the consumer portion of it has almost gone. And so when you see those sorts of analysis, I think that the Fed, one of the Fed regions, had this analysis about when the consumer savings were going to be depleted and stuff. I believe that the kind of that extra, sugar high that we got by mailing people money and putting it into their checks is almost gone.
Right.
But
and all the forbearance programs and all that stuff.
Right. And I think we're almost through that. And that is what the market has been concerned about when they've been thinking about the recession that was, imminent and was going to come and hit at any point. But at the same time, as I mentioned, those stimulus programs, or the Inflation Reduction Act, which is really an infrastructure program that's designed to kind of bring kind of manufacturing back to the States, that's just started. Like that we have barely felt that. And we are going to go and we are going to be surprised at how many jobs continue to be created. We're going to be surprised at the amount of CapEx that is going to occur in the US in strange places that we're not expecting. And so I would argue that the nature of the stimulus has changed, but it's still got a long way to go.
Okay. So one of the questions that folks have asked around that is, how long can this fiscal winning out over the monetary efforts. And now it sounds like the monetary efforts might start easing a bit.
Right.
So maybe they actually have won the game, won the battle. But basically the big question is sort of like, hey, so will this just continue through the election? Like, is this all, whether it was all to do with, rescuing the economy, or whether there was, some sort of additional agenda of trying to keep everything goosed through the November 2024 elections. Is your expectation that we're still going to sort of see a rising tide of fiscal spending through the end of this coming year, or do you see it maybe ending sooner?
No, 100%. We're going to see continued rise. There's the reason that there's the kind of time-honored election cycle when it comes to stock markets and economy. It's because presidents and parties spend based upon that cycle, and this will be no different. And so the real question is the economy the same as the market? And that might be something that will be different. Just because the economy is doing better over the next year doesn't necessarily mean the stock market's going to do better. And I think that too often people kind of confuse them and think that they're one and the same. Whereas I think that very much I'm confident that the economy will continue to do well, but I'm not as sure about the stock market.
Okay. And obviously I'm going to get to your market outlook in a bit.
Yeah.
This topic of fiscal spending, what you kind of worry about here is like the bear's gotten the taste of meat, right? Right? Like once he's
Yep.
tasted it, he doesn't want to eat anything else, right?
Yeah,
But
that's
of
right.
course, politicians love nothing to do but spend.
Yep.
And honestly, in a pinch and hard times, consumers they're not going to turn away handouts. In fact, they're going to demand them because they're just trying to put food on the table, and you did it before. So the precedent's been set, right? So are we in a new era when we're sort of talking about new forms of normal? Are we in a new era of just kind of ever fiscal spending from here? And what does that look like in the long run? My mind says that has a bad ending.
I do believe that the world changed at COVID. If we step back and we think about from 1982, when Volcker beat back inflation with high monetary interest rates, every single recession that we've experienced, we fixed it by going and lowering interest rates. And if you go look through the period of all the different interest rates, every single time we had to lower it to a new low. And then on the subsequent rise, interest rates didn't get as high before the economy rolled over. So during that whole period, we were relying solely on private sector credit creation to affect the business cycle. And eventually what happened was that we stacked so much private sector debt on it that we hit the great financial crisis. We lowered rates to zero and it didn't work. So then we tried all this, extraordinary measures of monetary stimulus. Those still, in essence, didn't work. And what happened in 2020 was they said, okay, this is no longer working. We have to think about other ways that you can create money. And so we talked about the fact that lowering rates encourages banks to lend. Credit creation, that's private credit creation. And what this time they decided they were going to do, government, they were going to spend the money into existence. And I'll tell you one thing that over the years, I'll tell you a little bit of my MMT story. I at first, when I heard MMT, I was like, that sounds like the stupidest thing I've ever imagined, right? Like I would hear things and I would hear them talking about spending money into existence and all this stuff. So I went and I actually decided, okay, if I'm going to be able to argue this, I should be able to go and figure out where they're wrong. And if you think about MMT not as a prescription in terms of what should be done, but as a description of how the economy works, they were actually, a lot of their theories are just spot on correct. And what they argued was that the government can spend money into existence up until the point where real resources are constrained. And then from there on, you get inflation. And if we think to the problem of the great financial crisis, we had a situation where private sector was not spending. And what did the government do? Instead of actually stepping in and spending when there was lack of private demand, they actually did the same thing. They cut back. And we had a situation where Obama, even though everyone talks about him being the spendthrift president, if you look at his discretionary budget, it declined like 3 out of the 4 years after the great financial crisis. So we have a situation where the government previously did pro-cyclical cuts in spending at a time when the economy needed the opposite. Now, the pushback to MMT has always been, well, once people start spending and they realize that they can spend this, they're not going to stop. And that's kind of the argument you're just making. And I am sympathetic to this. And I've always said that once like MMT, you can rail about it, you can spit on the ground every time it's mentioned. But if that's the way the economy is headed, and that's our way our society is headed, why are you sitting there arguing with the market about it? Like, just take advantage of it. Say that this is where we're headed and this is what we're going to do. So therefore, I need to change my portfolio. So I'm a big believer in trade the market that you have, not the market you want. Mm-hmm. And so I look at it and I say, okay, if you look at the median voter, and that's something Marco Papic, one of my buddies from Clock Tower, talks about all the time. And I think it's a great way of thinking about the political landscape or in what the person does. If you think about the median voter in 2008, when we had the great financial crisis, was all about balancing budgets. They were like, okay, we need to balance the budget. We need to get our spending under control. Think about 2020. Like 2020 was like, no, we should spend. And even 2021, 2022, think about the Republicans. They were like, oh, we're going to shut down the economy to balance budgets. And then when it came to it, they didn't want it. So I completely agree with you that the bear has tasted, the taste of meat, and he's not going back to eating blueberries. Like we're in a new era where we're going to have continued fiscal spending. And yes, it'll go up and down in waves as we get kind of cyclical moves. We'll have a recession, and this time, instead of trying to fix it with monetary, we'll also again use fiscal. And instead of arguing about that and deciding that which one is better or which one is proper or which one is moral, just say this is the way it's going to be, and I need to adjust my portfolio. And what that means is that we are going to have a series of inflation. Higher sets of inflation for some time to come. I used to argue that 2% was a ceiling that we would get in terms of every time we kind of popped up to 2%, it went back down in terms of inflation. I think that 2% is going to be the floor that we bounce off of. So I could see a situation where for the next decade, we average 3-4% really easily.
Okay, I want to get to the Fed in just a second. Okay, so first off, I'm sure there's already a little bit of a rage fest going on in the comments of, oh my God, this guy's pro MMT. I don't think you are. What I hear you saying is you understand, a good amount of the logic behind it, but right or wrong, you just think it is going to be more of the playbook that the central planners play by going forward. And so rather than fight it and get steamrolled as an individual investor, play the markets that you have ahead of you. And I'm going to jump to a punchline here that maybe we'll talk a little bit more detail about in a bit. But I believe that you are sort of a proponent of owning gold. And I believe that's probably because you expect there to be inflationary repercussions from this new, more MMT-driven playbook. Is that an accurate statement?
Yes, over the long run, I believe that is one reason to own gold. Another reason I think to own gold, which I actually think is even almost a better argument, is the fact that once Russia went and took over or invaded Ukraine, the world changed in terms of when the Western and led by America confiscated those FX reserves.
We weaponized the financial system against.
That's correct. Yeah. And if you're sitting there and just put yourself into China's shoes for a second, you're sitting there with how many $1 trillion of US reserves. As a percentage of those reserves, you have a tiny amount in gold. It's tiny. Like it's yes, they are one of the biggest holders of gold, but as a percentage of the reserves they have, it's very small. So if they were to just go and get their reserves up to the same level that a lot of the other countries are at, it would require just gobs and gobs of buying in gold. And that's what I think we're seeing. And if we look at this past year, what did we have? We had rising US interest rates. For a long time, the US dollar was rising, and yet gold hit an all-time high.
Yeah, it hung in there.
And right. And so
sorry to interrupt it, but real interest rates were the highest they'd been in a long time, which tend to be kryptonite for gold. Yeah.
That's right. And so I've been arguing for a while now that when you're, again, throw away the old playbook. the old playbook about gold being tied to interest rates or real interest rates and US dollar, it's not as important as just what the central banks are doing. And the central banks, if I was sitting there and I was the like running the People's Bank of China, I would just be buying it every single day. And it would just be it's almost imprudent not to be. And so ultimately, I think that you don't even need that kind of increased inflation for gold still to work.
That's
I
just
think that,
gravy, is what you're saying.
yeah, I really do. And listen, do I think that when the dollar finally goes down and the interest rates get lowered and real rates go lower, that won't help the gold? Of course it will. That'll be kind of an extra little boost, but that's not the real driving force of this bull market. The real driving force of this bull market is the Bank of China buying gold because they have to.
Okay, so it's much more a geopolitical factor where it's sort of
That's
a
correct.
national sovereignty priority. So when you said China's got a long way to go to catch up to other countries, are you measuring that as a ratio of gold holdings to U.S. Treasury holdings, like just the
That's correct.
percentage?
Like I can't remember the numbers off the top of my head, but I think a lot of like Russia, I believe, was 30 or 40% gold, and there's no way China's going to get to that in level. But there's lots of countries that have 5 to 10% of their reserves in the form of gold. And if China were to do that, it would suck up every single gold ounce that we mine around.
Okay, and that's, I guess, the punchline I was looking for, but guesstimating here, like, is it a 10x increase from where they are right now, a 100x increase? Like, what's the size of what that catch-up would need to be?
I think they're going to try to buy everything they can without sending the prices to the moon.
Okay,
I just think they'll just be constantly on the bid. And I think that's what we've seen. It doesn't matter, what the rates are doing. It doesn't matter what the US dollar is doing. It just keeps driving higher and higher and higher. And that's what I think it's going to continue to happen.
Okay, well then let's look from here then. So we've got gold. I don't know whether you ascribe to this or not, but it's sort of made this like decade-long, cup and handle with the triple top and all that. And it's if you look at it, I was just looking at it, a chart of it this morning. It's like poised right there to
Yep.
break out, right? And you look at the landscape that we have right now, which is, the Fed basically just told everybody, hey, we're going to start winding this down sooner than later, right? So everybody's now thinking pivot sooner. Everybody's thinking, oh, maybe QE again at some point, right? Hard not to see that. I know you're saying that's not the driving force, the primary
Right.
driving force behind gold right now, but hard not to see that adding additional wind behind gold sales, breaking it above that, out of that handle. And then, maybe there's some real momentum chasing that goes on from there. What do you think?
Oh, I think I've been saying for a while that I think we're going to have $1,000 up week in gold. And I know that sounds ridiculous, but if you think about it, it's not as crazy as it sounds. It's a small market when you look at the other big markets out there. And it wouldn't take much. Like I could see one day we get up, it's up $300, then the next day it's up 200, and then another 400, 200. It really wouldn't surprise me if all of a sudden out of nowhere the thing just takes off like that.
Okay.
So I'm open to those sorts of moves, and I almost expect them eventually before this bull market is over in gold.
All right. And sorry, I didn't mean for us to fall down the gold hole, but this came up at an opportune time. So you may not have an answer to this, but I remember hearing stories from guys like Ron Paul, who during the Volcker era, met with Volcker, and Volcker would be saying like, right, where's my daily gold report? And the central bankers were using gold as a mirroring, they were concerned about its ability to mirror inflation as they were monkeying around with stuff, right? And so
Yep.
they had a vested interest in trying to keep it contained. And long-term precious metals investors, hard not to be a long-term investor and get really frustrated by good conditions where the precious metals don't perform the way that you want them to, or they get monkey hammered at predictable times or whatnot. So I think there's a general sense, true or not, is that it's a pretty manipulated asset to begin with. But in this new world order, do the central planners care as much about keeping gold contained, or could they,
No, they don't care.
lift their foot off the throat?
The Federal Reserve doesn't care what gold does.
Okay.
Like they care what inflation does. They care about what bonds do, but they don't care what gold does. Like you sure at the margin they're going to watch it and stuff, but they're not going to change policy because gold's going up. They understand that gold is a different sort of asset, and for the reasons that I just mentioned, it could go up on its own even if inflation is very well behaved and there is proper monetary policy. Like we could just have a situation where China wants more. And if that is the case, then we could have gold going up, and doubling over a course of a year. And it doesn't mean that the Fed is too loose. It could just mean that the China wants them.
Okay. Well, at the risk of starting like another fight in the comment section, we don't, I don't want to go deep into this, but just since we're on the topic of sort of monetary inflation hedges, per se, I know you're saying that's not the exact main reason to own gold here, but thoughts on Bitcoin and or any other
Oh,
cryptocurrency that you
I am
think?
the worst. Listen, Adam, you don't want to ask me my Bitcoin because I am an idiot. I literally got told Bitcoin at $5. Of this kid beside me was I was trading, and he was a computer guy. He told me Bitcoin at $5. He explained it all to me. I told him that was the stupidest thing I'd ever heard. Don't mention it again. He then came back to me a month later and said, that thing you told me is the stupidest thing ever. It's now $50. I was at least smart enough to realize that if it goes to 50, it could go to 500 or maybe 5,000. I thought on some fluky chance. So I actually started way back when Bitcoin was 50 or $100. I started mining it. I had an interlisted ARB machine. We did all these sorts of fun things with it. And then it kind of collapsed and it went quiet. And people forget that it went quiet for a few years. And I was just like, I was always kind of a skeptic. And I thought, okay, well, that's it. It's never going to go again. And I've just completely missed it. So I am not the right guy to talk to. I am a little bit of a skeptic. At the end of the day, I think that it's an asset that the government can control and shut off more easily than people believe. The one thing about gold is if you own gold and you physically own it in your possession, it is nobody's liability.
Right.
Now you might say that about Bitcoin. You'll be like, no, it's up there. It's nobody's liability. Well, it's still, you have a liability that the network needs to exist. Like just take us for a second and imagine we have a situation where China invades Taiwan. I don't think this is going to happen. Well, let's just say it happens. We have a situation where China invades Taiwan, and all of a sudden they shut off the internet, the pipe between the US and China. Now all of a sudden we have the fork of the Bitcoin, and we have miners in China, miners in the US, and they can't go back and forth. I still think that there's more of a kind of a liability to the network than people think.
More
And
counterparty risk.
yeah, well, it's not counterparty risk so much as it's kind of technology risk. But ultimately, at the end of the day, I believe the government controls that technology more than we think. Like
Mhm.
I think there's 7 big routers in the whole world that all the internet traffic goes through. Like I'm sure the government can do stuff against it. Now you listen, people a lot smarter than me have come up with lots of reasons why I'm wrong, and I have no interest in debating them. I'm just an old fart that doesn't like it, and I'm going to stick with my gold. And I have no hair, and what hair I have is gray, so that probably just says it all.
All right.
Although it didn't stop Mike Novogratz from doing it, did it? Like he has no hair, just like me, and he's a little more progressive than I am.
And it sounds like he's probably sitting on a greater pile of crypto wealth at this point in time.
That's right.
But the last question on this, which is the geopolitical reasons for central banks, particularly ones like China, to load up on gold. I don't get the sense that you feel that that same dynamic is pushing those same players to, for some reason, favor or get into Bitcoin/crypto.
I'd be surprised if the Bank of China was buying crypto, and I could be wrong. Listen, you know what? I I think that people need to remember that one of the things about a trader is that you need to make sure that you understand that you're going to be wrong all the time. I saw Anthony Bourdain has a tattoo on his arm that says an ancient group, I am certain of nothing. I think Anthony Bourdain would have been a great trader. And I'm the same way. I am certain of nothing. So do I believe that Bank of Japan or Bank of China is going to be buying crypto? No, but anything can happen and maybe I'll be proven wrong.
Okay, wouldn't shock you, but not part of your thesis, and that's
Yeah.
really all I wanted to clarify. Okay, well, look, I just mentioned, the Fed's recent move, potentially adding was certainly adding wind sales to the markets, but maybe adding special wind to the sales of assets like gold. Um, I'm curious, lots of ink being spilled about this right now. A lot of people calling it the Fed pivot. Obviously, the market has taken the football and just running with it.
Yep.
Do you see it as a pivot?
Oh, yes, for sure it was a pivot. Like, let's step back and think about September 20th. It wasn't that long ago. At that point, the Fed was raising 12 and a half bips a meeting, meaning that they were definitely on a schedule of one hike every second meeting. And if you think about their evolution of tightening, it started off with, like, I think the first one was 25, then they did a 50, then they did some 75s, and then they went down to 50, then they went and did some 25s. And as they got closer and closer to their target, they reduced the pace of tightening. And I think that, Powell talks about it. He was feeling around, trying to figure out the point where they were sufficiently restrictive. And as they got closer, they slowed down the pace of tightening. So September 20th, the market was thinking that they had stopped, and they came out and they actually very clearly said, no, we're still not there. We think we're close, but we're not there. And if you think about back then, I'm just looking at my notes here. I think September 20th, the US 30-year was 442. Then a month later was 5.5. The market was caught off guard about how hawkish the Fed was still at that point. So what we did was we had a huge tightening of financial conditions from September 20th all the way to like the end of October. And at that point, the Fed, we hit this level where we kind of hit the pain point for the Fed. And they came out and they said, there was, in essence, they said the tightening of financial conditions has done the work for us. We don't need to tighten anymore. So we're going to pivot. So that was the first pivot they did. They said, looks like we've hit sufficiently restrictive, and we've hit that because we've had this tightening of financial conditions.
Can I ask a question about that?
Yeah, sure.
So you did answer as you keep going on here?
Yep.
That surprised a lot of people because there's a lot of financial conditions indexes that have been rising all year.
Rising in terms of getting easier.
Loosening all year.
Yeah,
so
but I think
people are wondering,
most of them at that point, from that kind of September 20th till October 30th period, were tightening.
Okay, that's right. As the markets were
right, because we had that huge crush in the long end of the bond market, right? Like the bond market just went no bid. And look, let's think back to that period. Everyone's forgetting about it now, but there was all sorts of talk about, term premium. People that don't really even understood what the word was were, like lecturing folks about how the Federal Reserve wasn't going to be able to fund it, or sorry, the Treasury wasn't going to be able to fund the US government because the bonds were going to go no bid. The term premium wasn't wide enough and all this stuff. And Adam, listen, you can go back and look. I've written for Bloomberg for a couple of years now, and I wrote pieces a couple of years ago about how the bond market was a disaster waiting to happen. And at that time, I got told I didn't understand the bond market. There was like lots of people have predicted kind of a bond bear market, and lots of people have gotten crushed. And I kind of think back to the pushback that I got when I was bearish of bonds a couple of years ago. Well, in October, I got bullish of bonds. I said, listen, this thing's gone a long way. We're now at a point where the term premium is actually positive. We have just sentiment off the charts bearish. And it was kind of just ironic how when I got a little bit bullish at 5%, I got told that I didn't understand the problems with the US government, and that we are not, like, the bonds were going to head to 6, 7, 8%. And here we are, the thing's gone from 5% down to 4% in the space of a month. And that was largely a function of the Powell pivot. So that was the first pivot. But what was really interesting was that as financial conditions loosened, right, we had a situation where they pivot, all of a sudden financial conditions loosen. We get to the point where we're actually looser than we were when they first worried about it. Okay. And most people at that point, and me included, expected the Federal Reserve to say, hey, wait, you know what, guys, like we've eased enough. We're going to be on hold. Everything is fine. It's time to be They didn't want to goose it anymore. They would push back on the easing of the financial conditions, is what most people expected, like a
Right.
couple of weeks ago.
I,
And
I
then,
I would put myself in that camp.
yeah, I was too. But then I very quickly, you know what? There was a couple of instances where Powell was given a chance to push back on that, and he didn't take it. And at that point, I was like, oh, wow, look at this. Here it is. They just served him up this softball, and he didn't take it. And he did not push back on the the easing of financial conditions. So I would argue that the recent Fed move, when actually at the FOMC meeting, shouldn't have been as much a surprise as it was. But ultimately, too many people, fell for this idea that Powell is not going to be the next Arthur Burns. He's going to be the next Volcker.
Right.
And I'm going to give you my theory. And here you go. You were talking about conspiracy theories and stuff like that. I will gladly jump into this conspiracy theory. And I truly believe that Trump is scaring the establishment, and that although I don't think it's as overt as Powell saying, I don't want Trump to get elected, so therefore I'm going to ease, at the margin, he has changed the equation of the risk reward in terms of how Powell sees the market. So everyone said to me, but Powell doesn't want to be the next Arthur Burns. And I said, no, you're framing it wrong. If you go back and look over history, for the past 100 years, no president that has had a recession during the election year has won. I think the last one was Calvin Coolidge in 1924. So when you're thinking about Powell, he can go and raise rates and push the economy into a recession to get inflation down from 3 down to 2%, like all you guys think he's going to do. That's one option. Another option is he says, you know what? We're pretty close. I don't want to be the one pushing the economy into the recession. I'm going to ease up. And I truly believe that when he looked at the kind of risk reward, he's willing to accept a little more inflation at the, he's willing to accept the chance of a little more inflation for the possibility of maybe averting a recession.
Okay, so averting a recession, okay, I can believe that. But you mentioned Trump earlier. Is his desire to avert the recession and take on a little bit more inflation risk, to your point, because he wants things to remain rosy enough that the current administration gets reelected and keeps Trump out?
I don't think it's the current administration. I don't think that he cares if it's Biden or if it was, let's say, Nikki Haley. And I think that if Nikki Haley was the GOP nominee, that he wouldn't have been as easy as he currently is. I think that Trump, whether, and listen, I am not making any sort of political opinion about what should be done. I'm more interested in what will be done. And I'm just trying to read the tea leaves as I see them. And I do believe that Powell and a lot of the political establishment don't want Trump to win. They view him as a risk to the government.
And Trump said, I get reelected, I'm booting Powell from office. So Powell already kind of knows his job's at risk there. So, and again, yes, folks, this is a completely nonpartisan conversation we're having here.
Yeah.
We're just trying to understand, the mechanics of what may happen. So help me understand, how does recession equal Trump versus recession equal Nikki Haley, or,
Well, Nikki Haley, what I was saying is right now, Trump is the leading contender.
He's
for the
leading
GOP.
everybody. Yeah.
Right. So what I'm saying is you'd have to assume for now that he's going to win the nominee. So he's going to be the Republican nominee, and therefore a recession, as I mentioned, there hasn't been a president that's presided over a recession and has won since 1924. So if we assume that Trump wins the GOP nominee and then we have a recession, everyone's like, get Biden out of there, his economy stinks, and all of a sudden Trump's the kind of next president.
Right. So again, and I'm just trying to understand the mechanics that Powell has to help engineer this. So as long as Trump's the front runner, we go into recession. History shows that Trump should win, Biden's out. And so I get that. Now, if Trump started losing in the polls and you had somebody else on the Republican ticket start, gaining a comfortable lead on him, do you think Powell might change
I think
course?
at the margin, Powell would change. And I don't think it's as overt as everyone thinks it is. Like he's sitting around in Machiavellian thinking it out. I just think when he's thinking about the risk reward of the different choices, he's like, oh, geez, like I could go and I could be really tough on the economy right now. And I could push us into a recession to try to get that last 100 basis points out of inflation. And then I'll be the guy instead of being Arthur Burns, I'm going to be the guy that handed Trump the victory. Right. And that's how he's thinking about it. So at the margin, he's always kind of trying to weigh pluses and minuses. And so if you're asking like if Nikki Haley all of a sudden wins, then yes, I think at the margin, Powell will become, slightly more hawkish. It won't be like all of a sudden, like we were pricing 6 and now we're going to do 0 because Nikki Haley is there. It's just at the margin when they're trying to decide the balance of risks that equation will change.
Okay. All right. Well, look, there's been a lot of, well, I want to ask your opinion here.
Adam, can I talk
Yeah.
before we talk about the Fed? One last thing about,
Yeah.
I think another part that people miss is that that too often they're talking about inflation kind of in a rear view, like looking at it in the rear view. So they're thinking about right now, they're saying inflation is whatever it was, 3 and 30 or whatever it is, instead of thinking about what inflation is going forward. And if you think about John Williams, who's the New York Fed president, he spoke about this. He said, really what you need to be doing is looking when you're setting policy, you set policy based upon what future inflation is expected to be. So if we look at the 1-year inflation swap, meaning the rate that the market thinks the next year, the rate of inflation over the kind of forward 1 year, it actually had declined from 265 down to 2%. So when Powell went and in essence in this last meeting, and not only did he not push back against the easing of financial conditions, he seemed to endorse rate cuts in the next year. What he was in essence doing was looking at what inflation has done and looking at the real rate. So if you look at the 1-year kind of treasury rate, you'll see that it is kind of fallen from 5.5 down to 493. So it's declined almost 60 basis points. And so everyone says, look at how much he's eased financial conditions. But in some ways, in their mind, inflation is their policy rate is just as restrictive today as it was 3 months ago, because the real rate, meaning the rate above future inflation, is the same. See what I'm saying? It's if you're thinking about forward inflation, if you're setting policy based upon forward inflation, as inflation falls, as the expectation of inflation falls, you can lower the nominal rate without actually loosening policy.
Right. Okay. Yep.
That is what they believe. Whether you believe it or not doesn't really matter. Like, because don't forget, it doesn't matter what we think is right. It matters what we think, understanding what they believe. And so to some extent, they don't view this last kind of easing and putting those cuts in as easy as we think it is.
As big a policy shift as the markets are taking. Okay.
That's correct.
So Kevin, I mean, we could talk for 5 hours on this. This is wonderful. I'm gonna jettison the question I was going to ask you on the Fed, because we got enough of that out of there, but you're opening a really other interesting door, and we're getting a little tight on time. So I want to make sure we get enough of your market outlook in here. So sounds like you think that market participants are their future inflation expectations are coming down, right? That should be good for bonds, right?
Yes.
Especially if Powell continues to cut rates, and if we ever even go back to QE, that should be really good for bonds too. So we're at a moment in time where this year equities have gone from richly priced to very richly priced to becoming even more so as you and I speak here, basically. When you look at stocks relative to bonds, The equity risk premium, it's kind of at one of its worst levels versus bonds in like decades, right?
Yep.
So are you expecting bonds to do very well next year? And if so, uh, uh, well, let's talk about bonds first, and then we'll talk about your stocks outlook.
Well, the trouble about the bond market is that it's gone so fast, and that when we were talking, it was 5% on the 30 or 5.25 on the 30 year. We're now down to 4, and it's moving so fast that it's difficult. And that's part of the reason that stocks have rallied so hard, is because the bond market has rallied so hard. They've been kind of tied at the hip. But if I kind of think about, step back and take a bigger picture look at things, and I think about the NASDAQ 100, and I think about it back in March of 2020, when everyone was convinced the world was going to end, and that that the stock market was never going to go up again. I think that the NASDAQ 100 had an earnings yield of 5.5%. And meanwhile, the 30-year was 1.5 or 1 or something like that. So the difference between locking in your money and giving it to the government versus going out and buying stocks was huge. Now, fast forward to kind of in October, especially when rates went back up to 5%, the earnings yield on the NASDAQ, I think, was 4.5. And so when I think about the kind of changes that will occur in a lot of financial committees coming the new year, they're going to start to look at their makeup of their portfolios and say, hey, you know what? We're long stocks. It's been a great run, but relative to bonds, we can now lock in some great levels. And I think Howard Marks from Oaktree was talking about this, how you go out, you start buying a little bit of high yield, you can all of a sudden hit your 8% return by buying a fixed income, security, as opposed to a stock. Stocks over the long run are expected to yield 8 to 12, perform 8 to 12%, but stocks are stories and bonds are contracts. And a lot of these bonds now, all of a sudden, we have a situation where you can actually lock in yields and lock in funding. And I think there's going to be a shift. And I think that that's going to be something that the market misses as well, is that the big long-term money, I'm talking about like the CalPERS and the Yales and all those kind of things, they're going to look at this and they're going to rejigger their portfolio from, owning, stuff full of equities, and they're going to start at the margin buying bonds. So I ultimately am not a huge bond fan, but I do think that relative to stocks, they're attractive.
So a couple of questions on this. One is, how material will the capital flows be out of stocks into bonds? Enough to actually challenge stock market valuations, or?
Yes, for sure.
Yeah,
I think
sure.
at the margin, we're going to start to see more selling in stocks, and we're going to see more buying in bonds. And I think we're going to be surprised at that the performance between those two changes. The equity risk premium, as you mentioned, is at levels that dictate that that's the smart, prudent thing to do. Right now, stocks are running and everyone's all excited about it. But the longer term, more patient money that thinks about things in the bigger picture will be doing this trade, selling the stocks when they're expensive.
Okay, so I had a bond analyst, Alf Peccatiello, on the program not that long ago. He also runs a pretty successful Substack. But Alf makes a very similar predictions that the bond whales, who have been on a relative basis, buying a lot less in recent years, are now going to move in for a lot of the reasons that you just talked about.
Yep.
One additional reason he mentioned, and I just found this chart here I want to pull up, I just want to get your thoughts on it, was the correlation that stocks and bonds have. That his analysis shows that at a high enough level of inflation, bonds and stocks no longer become inversely correlated.
Right.
And so we've been in this high inflation, period where bonds weren't giving you the counterbalance that you wanted them, right? And now that inflation is coming down and expected to come down further in the future, these guys are saying, hey, I can lock in those tasty returns, but I can also now finally get that negative correlation to diversify the way that I want to. So it's another reason for these whales to be, buying into this market. Do you agree with that?
Well, no. So I'm in a slightly different camp. And part of the reason that I'm hesitant to get too bullish on bonds is that ultimately I am a believer that we are going to have more inflation. And I am a believer that this economy will likely be run hotter. And everyone's all excited about the fact that Federal Reserve has just pivoted dovishly. But if you think about it as a long-term bond investor, it's actually the worst thing that could happen to you. Everyone thinks that they want, the Fed to loosen rates to be bond positive. Yes, you want that over the short run. Over the long run, the Fed has just told you that they're willing to accept more inflation.
Right.
They're willing to risk more inflation. And as a long bond investor, assuming no default, that is actually what is your ultimate enemy. And so, over the long run, I believe that we're going to get more inflation and therefore bonds are not a great investment. So when I'm talking about the shift, I'm expecting more of a shift kind of into corporate bonds, more things of that nature. And I suspect the government bonds, especially at the long end, will be surprisingly weak going forward. And I think that they're not the greatest investment. But I do find it interesting that you're bringing up the stock bond correlation, because when I think about the biggest challenges facing investors kind of going forward, I think that flipping of the stock bond correlation is the number one most kind of difficult thing for them to deal with. And so what do I mean by that? So if you think about
Them being the Fed, them being who?
No, investors. That is the
Okay.
most difficult thing for, like we can talk about the Fed. The Fed doesn't really control the long end, they control the short end. But if we think about investors and kind of what the last 40 years, we've had just this great environment where bonds have been negatively correlated to stocks. Okay. And they've also been in a huge secular bull market. Up until 2020, it was just the greatest of all worlds, because rates went from 18% in 1982
Right.
down to zero basically on the long
40-year
end.
uninterrupted tailwind. Yeah.
Yeah. And not only that, the fact that the bonds and stocks were negatively correlated was so important, because in essence, that meant that you could lever up your portfolio, because at a time when your volatile asset was doing badly, you could count on your non-volatile asset, the bonds, to perform better. So, Ray Dalio became the richest hedge fund manager of all time by taking advantage of that and instituting risk parity. So when we have this situation where in the last couple of years that kind of correlation is broke down, and not only is it broke down, it's actually flipped. That was why we had a situation where the 60-40 had two of the worst years that they've ever had, because the bonds and the stocks were going down at the same time. And one of my lines that I've always used, Adam, is I've always said, be careful about bonds. Everyone expects them to be a ballast in your portfolio. I think they're going to turn into the anchor. And ultimately, I do believe that is still going to continue. And so, especially the long end. So when I say bonds, like back to the equity risk premium, I'm thinking more you replace it with like 5-year corporate bonds and things of that nature, as opposed to going out and buying long dated bonds. Because ultimately, I think this move is most likely done on the long end. Although I could see a situation where the Fed lowers rates, but I could see the Fed lowering rates, yet the long bond actually rising in yield as investors become increasingly uncertain that the Fed is committed to their 2% target as much
To their
as they
inflation
say it
target.
is. Yeah.
Okay. So just to be fair to Alf, his outlook is, tailwind for bonds for 2024, but then he expects there to be secularly higher inflation going forward. So, it's sort of a shorter term outlook, and then you want to get out of it.
Yep.
I'm curious, where you're saying is do you even expect much more of a continued downtrend here, or do you think people are going to start worrying about inflation sooner than most people?
I think we're almost at the end of the bond bull market that we've experienced in terms of this correction. Like we were in a bond bear market, and we've had this correction at the Fed pivot, and especially at the long end. I think the long end is going to struggle from here. Like, let's just stop and think about what happens when the Fed goes and actually eases. Usually the Fed eases, and what happens is the bond market steepens, the yield curve steepens, meaning that the long end and the short end, the difference between the two rises.
And usually the short end goes down, but
yeah. So if we get a situation where the Fed, like, you have to ask yourself, what do you think is going to be the new lower limit of the Federal Reserve rate? Like, where is the Fed going to stop? And if you believe that we are back into the environment of the post GFC pre COVID era, where interest rates are going to zero at the front end and we're going to be, stuck with very little growth, then for sure you should go out and buy bonds. But if you believe, like I do, that the fiscal stimulus will continue and that even when we get a situation where all of a sudden the economy does bad, we will see more spending. And I think we'll see increased inflation going forward. I could see a situation where the Fed really, the new kind of lower level is 2%. So if you go to 2% and you think about the fact that in a normal yield curve at that point when they're the kind of the most easing, you get a 250 basis points between twos and tens. That means 10 should be 4.5%. And so I suspect that from here, you're going to be kind of the long end will be a wash. You'll be hard pressed to kind of do more than earn your coupon, I think, from here.
Okay, let me just bring up this one chart for a second, just to get your reaction to it, which is, this is the chart that shows the federal funds rate, prior to each recession that we've had over the past 30 plus years. The recession's been preceded by a pretty aggressive run up in rates. Then we peak, we plateau for a little bit, and then rates plummet as the Fed basically is chasing the economy down, saying, oh gosh, I over tightened, I got to stimulate here. What I hear you sort of saying is this time might be different because of this new normal we're in. Is that true? Well, but you're talking about this new normal. So, I mean,
I wouldn't say it's a new normal. I would say it's the shift from monetary, our Lynn Alden came up with this, the shift from monetary dominance to fiscal dominance.
Yep.
And I believe that that's what you're going to experience, is that it's changed the playbook. So remember when I mentioned how the peaks were always lower? Can you put the chart up again?
Oh yeah, absolutely. Sorry about that.
Sorry, I didn't mean that. I want to show something here because I think it illustrates what I say. So if you look in 1987, that peak was 12, and then we lowered rates to 3. Okay, and then on a subsequent rise up, we went to 6.5, 7, and then we lowered rates to and then we lowered rates to 1. Then we went up and we went to 5, blah, blah, blah. And so each time, now think back, we forget now, but there was lots of people saying when we would hit 2%, they were saying the economy was going to roll over.
Yeah.
Like
I interviewed a lot of them. Yeah.
Oh yeah. There was tons, like Goldman Sachs, a lot of people. And the thing that going back, what did they miss? They missed the fact that there's fiscal. So if you could tell me that tomorrow we're going to get a government that is going to try to balance the budget, is going to stop spending, and is going to rein in everything, then I would tell you I would completely change all my outlooks. I would say, in that environment, we're going to see a situation where we very well could go back to the lows and we go back to 0%, and we have a return to that old thing. But I don't believe that's going to happen. Like, as your great analogy about the bear tasting meat, I think that we're going to be surprised at how much politicians find excuses to go and to keep spending. And ultimately, I think it was Bill Fleckenstein that came up with this. He says the governments are going to keep spending until the bond market takes away the keys.
Right. Right. Yeah.
And
take away the printing press.
Yeah, and that's a great line. And I think that he's probably on something. And so I'm just hesitant to go and get too bullish on bonds or to get too bearish on the economy, because ultimately, if the government, steps in and spends, the one lesson we should be taking from the COVID example is the fact is that the government can go and can fill an economic hole way better than anyone imagined. And that's kind of the real lesson, right? If the government spends, they can affect the economy. Now, we can argue about whether over the long run that's going to cause pain or whether that's going to cause the economy to be as efficient as it should be. And I have no desire to debate that, because I don't know, but I don't even think it matters, because the reality is that we're not trading over we're not putting on our portfolios for the next 30 years and forgetting about them. We're putting it on for the next 3-5 years. And over that period, I contend that I think that the government will continue to spend.
Okay. Well, so in wrapping this up here, I want to get to your kind of market outlook, and you can put whatever term you want on it, the next 3 years, the next 12 months, whatever you feel comfortable with, next 3 months. But what do you think is more likely to happen? This is not, a guarantee. This is just your best assessment. And what assets are you looking at right now as good ones to consider for that type of environment?
So when we haven't talked a lot about the Mag 7, but the reality is that everyone's expected a recession. And just to go show you how difficult this game is that we all play, is that if you go back to the beginning of 2023 and everyone was expecting higher rates, and the overwhelming consensus was that that was going to hurt long duration assets like tech stocks. And I was the first one to agree with that. And I thought that that was the case as well. And what's happened is the Mag 7 is just taken off. And for a variety of reasons, they borrowed long. They have all sorts of cash at the short end. We had an AI kind of an extra alpha boost from the AI kind of bull market. But increasingly, we have a situation where those 7 stocks have dominated like the zeitgeist, and everyone's bought them so hard that a lot of the other stuff is cheap. It is really cheap. Like you go look at small caps versus large cap are one of the cheapest PE, forward PE kind of differences that we've seen in years. You go look at foreign assets like other countries. Now, a lot of this has changed ever since the Powell pivot because a lot of these things have just run up.
Right.
But and the reason they've run up so hard is because there was so much crowding in those names, meaning
Right.
that everyone was long the Mag 7 and they were underweight / short everything else. And when I look at the kind of investing horizon and think about it, I really think there's continuing to be opportunities in those other names and those other kind of asset classes, like whether it be value, whether it be small cap, whether it be foreign stocks. I think that a lot of those things were held back by Powell keeping his foot on the throat of the economy. And at the very least, even if he didn't do it, there was always worry that he would. And I suspect as that changes, the nature of what works within the market will vary tremendously. And I just want to leave you with something here in terms of the NASDAQ. The NASDAQ was up 55%. The S&P this year, the S&P is up 26, but the S&P equal weight up 13.5%.
Yeah.
It's not that good. It really isn't. The Mag
Well,
7.
like what, a month and a half ago, it was up nothing.
Yeah, it was 0. The Mag 7's up 110. And one of the things that everyone always talks about, I find retail investors always think that institutional investors are so much smarter and they have so many more options and they're at such an advantage. And I always tell them, no, in essence, you guys are the ones at the advantage. First of all, you can get in and out really quickly. You don't move markets like a big institutional investor takes days, weeks, sometimes months to buy and sell stock.
Super slow. Yeah.
Yeah. But most importantly, they don't have the ability to sit through career risk kind of underperformance. So an institutional investor can't have the Mag 7 going up 108% and not participate. And a retail investor can just say, hey, wait, these are good stocks, but at this point, that makes no sense to chase those.
Too rich for my blood. Yeah.
Yeah, I don't have to do it. And so I really think that retail investors should think long and hard about taking advantage of the kind of career risk chasing that institutional investors must do. And one of the perfect examples of this, Adam, is that over the long run, there's been all sorts of studies about how equal weight outperforms market cap weight over time. It's just, you can go look at it. I think AQR has written about it. The other research shop has written about it. There's tons of studies out there that over time, equal weight wins over market cap weight. And the reason that that not everyone invests in it, first of all, if your CalPERS are one of those big guys, you can't invest in it because the liquidity of you trying to buy an equal amount of Apple and an equal amount of the 500 stock makes it so it just doesn't work. But even more important than that is you can't take the 1, 2, 3, 5 years of underperformance that we're kind of experiencing.
Right. And sorry to interrupt, but you also, I think, get the punishment or reversion to the mean, right? Where you have to chase into it because it was up 100% this year. You have to own it. Given the fact that it had an outlying year, the odds of it having an underperforming year are not bad given reversion to the mean.
Right. Because if you think about the equal weight right now, what is the equal weight going to do? They're going to be selling at the end of the year or whenever rebalances. They're going to be selling their Mag 7, right? Because they owned it at equal weight. It was all equal weight and they've all doubled. And
Right.
now they got to put everything else equal weight. So they're going to be selling their Mag 7 and they're going to be buying the stocks that underperformed or were actually down. And so long and short of it is that as a retail investor, you should really go look at taking advantage of kind of those constraints that professional investors are under. And when I'm thinking about it, we have a situation where this is extreme, meaning that those 7 stocks have done so well versus the rest of the market. And one of the problems I have whenever someone asks me about the market, I'm like, well, like I'm pretty bearish those 7 stocks. I don't see how like they're going to have difficulty growing into that. You just have to go back and look at the Nifty 50 in the 1970s. A lot of those companies ended up being absolutely terrific companies that did everything from a fundamental perspective that the kind of the bulls thought they would do. But in terms of investments, they were terrible investments. They went nowhere and they just kind of dripped for the next decade. And I kind of expect that's what's going to happen with these Nifty 50s. And so when I'm thinking about what I'm looking at kind of going forward, never before have I felt so strongly that you should look at not being in the market cap big name stocks, and you should really think about when you're kind of benchmarked to the S&P 500, you should be really aware of what you own and how much risk you're taking in those 7 names.
Wow. Okay, that's a bold statement, declarative statement. Never before,
huh? Never before. What do you mean?
Oh, I thought you said never before. Have you been sort of this concerned about the differential between the market weight?
So I'll tell you, the only time I've ever been this worried about it was I'm a Canadian, and we had a situation in Canada where Bell Nortel was our biggest stock, and Bell owned a big chunk of Nortel, and our index actually became 45% of the TSC 300. And it was terrible. It was terrible for active managers because think about it from a fiduciary point of view, they actually couldn't own 45%. Like it made absolutely no sense. So as this stock was rallying so hard, everyone was underperforming. And these things, I would be shocked if we have a situation where the Mag 7 is able to continue this level of outperformance. And I really suspect that as we kind of go through year end and a lot of these kind of finance committees meet and think about their portfolio and they look at it, they're gonna be like trimming this thing. And so I suspect that it'll be for sale for a long time. And I not only that, Adams, like one of the things is they've actually no longer are the leaders. Like think about this rally of the last little while. Like what did you want to own? Like the Mag 7, sure they're up, but they're not up as much as the rest of it.
Right.
Like, and so you buy the stuff that's the new leader. And I don't think the Mag 7 is going to be the leader like it was last year.
All right. Well, you're in good company too. A few weeks back, I interviewed Fred Hickey of the High Tech Strategy.
Oh yeah. Great guy.
He says he's about as bearish on the Mag 7 as he's been in over much of his career. So,
Yeah.
so it's good company to be in. All right. Well, look, this has been fantastic. And I love this point about that. The advantage of the equal weight index is being an advantage for the small guy. The whole mission of this channel, Kevin, is to help the small guy gain whatever edge they can against the power brokers who have had a lot of the advantage on Wall Street and have slanted the playing field to their advantage. So whenever we can find an opportunity here, it's awesome to be able to highlight that for folks. So thank you for doing that.
Oh, my pleasure.
Now, just from my notes, I heard, hey, look at small caps, look at emerging markets, look at corporate bonds, at least for the short term, looking out 5-year duration-ish or so. You like gold, you encourage people to look at equal weight indices, and you're cautious about the Mag 7. 2 last questions for you.
Sure.
First one, very important for folks that have really enjoyed this conversation, Kevin. Maybe this is the first time they've gotten exposure to your work or seen you live. Where can they go to follow you in your work?
They go to themacrotourist.com. And if you want to see some of the old pieces, just send me an email, Kevin@themacrotourist.com, and I'm happy to send you off some of the recent pieces.
All right, that's very kind of you and very courageous of you to share your email address there. And when I edit this, Kevin, I will put those up on the screen so
That's
folks know
great.
exactly where to go. Folks, I'll have links in the description too, so you can just have one-click access if you want to. All right, the second question I'm going to ask you right after I do just a little bit of housekeeping, so you can think about it, Kevin, is we've just spent the past hour plus talking all about ways in which we hopefully can, improve our financial wealth prospects from here. What's an investment that you would encourage somebody to consider adopting in their life that's not financially related? I've been asking this question of late and getting some really interesting answers. Would love to hear your thoughts. As you think about that, two things. Folks, if you've really enjoyed having Kevin come on the program, half as much as I have, this has been a joy for me, and would like to encourage him to come back on again, hopefully at some point early in 2024 to kind of give us an audible call on how he sees things. Let us know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And just a reminder, just as Kevin has his Substack, which you should totally go out and check, and I think if they go to macrotourist.com, Kevin, they can find their way to your Substack from there.
That's correct. Yep.
Okay, great. I have my new Substack that's out there. It's adamtaggart.substack.com. I provide a lot of free information on everything that's going on in this new thoughtful money movement. But I have also resumed my Adams notes, which are my cliff notes for my key takeaways from these interviews, including this one with Kevin. And so if you want to get those Adams notes, go to the Substack, subscribe for the premium service. You'll get it as part of the premium benefits. And just a quick reminder, it's very inexpensive right now. It's like $8 a month. That price is going up at the end of the month. And so if you're thinking about becoming premium, do so quickly because you can get grandfathered in at that low price. And as long as you remain subscribed going forward, you will keep that low price. So anyways, want to folks know about that. Kevin, we're here at the end with this final question here. What's a non-financial, non-money related investment you think folks would be wise to consider?
Yeah, I got two answers. I'm going to go with the cheesy one first. Life is short. Make sure you spend time with the family. Make sure you spend time with the kids. Kind of make sure you're not spending too much time staring at the screens and you're giving people your attention. You'll turn around. Next thing you'll know, I'm 53 years old. My kids are moving out of the house and I'm happy for all the time I got to spend with them. But there's lots of times that I wish I'd kind of been more aware, more present, spending time not worrying about what the next tick in the S&P was going to be and spending time like learning and listening to them. That's the cheesy answer. The other one is that we all know we have to keep learning. One of the things that I think that as traders / investors is you need to keep expanding your tools. And I think that especially the young people that are coming up and trying to figure out how they get into this industry, work on your programming, work on your Python, work on your R, like work on learning a computer language. And you don't need to be the next Bill Gates or whoever that's programming really fancy stuff. But these are increasingly are becoming the tools upon which we all use. And that's going to really differentiate your ability to understand and find kind of anomalies, find and understand the markets better. So anyways, work on your programming, R and Python.
Wow, those are both great. So for the second one, really kind of learn the fundamental language that, the future of business and the skills required to succeed, learn what that fundamental language is.
Yeah.
And I got to say on the other one about spending time, life is short. You're putting a dagger in my heart for two reasons. One, my youngest is a senior in high school this year,
Okay.
so we're staring at the empty nest coming up, and so I lament that fear of yours all the time, and it's been a really busy year for me. I've been running in startup mode forever, but recently just started thoughtful money even more. So I'm even more like heads down on what I'm doing. And it just kills me when end of the day, I stand up and I've finally done the last email or whatever. And then, she's already off to bed or whatever. And I feel like,
right.
Like one more day. Right. And tied to that, as you and I were talking before we put the camera on, as folks know, I think most folks know, my father passed away this past weekend. And yes, it's a reminder that life is short. And we always never get as much time as we want. And I will say, I'll probably have already talked about this in the weekly market recap at Lance, but like my dad was he was a older guy. He's 89, right? He was a man of few words, and there was a lot left unsaid, and I sort of always thought that like, oh, as his life was, as he could kind of see the end of his life coming, I sort of thought that, oh, maybe he'll be in a place where we can have some of those conversations. But this all just happened so quickly that
Yeah.
he was fine one week and then he was gone the next. So just never happened, right? And so just don't assume you're going to get that chance. Like, make the time now, as you're saying.
Well, Adam, and I'll just say this. I'm sure everyone's listening and will share my sentiments when I say we're sorry for your loss.
You're super kind. Thank you, Kevin. Anyways, just makes me like you even more after this wonderful hour that we've spent together. Thanks so much, Kevin. Like I said, I really hope to be able to get you back on this program whenever you want to come
Anytime. I
back
had a
on
great
here.
time.
This platform's here for you. Everybody else, if you are still hungry for additional content after watching this one, I just finished. Kevin mentioned that he has written in the past for Bloomberg. I just recorded an interview with Simon White from Bloomberg. Great analyst. I like Kevin, had never met him before. Really enjoyed that conversation. I'll put up a link to that right here if you're hungry for more. But other than that, Kevin, it's been a pleasure. Everybody else, thanks so much for watching.
Thanks, everyone.